I'm sorry to say I don't actually have a joke about average cost inventory method. I would refund the price of your ticket, but again, I don't charge extra for the accounting humor, so I guess we're even. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence. And we're here to put the fun in accounting fundamentals. Now, in this video, we're going to be looking at how to figure average cost for our inventory method. This is one that probably makes the most sense as far as the logic behind it. If you look at what you have purchased for inventory and divide it by the number of items that you've purchased, that gives you your average cost. It's the most logical. So we're going to jump right into the spreadsheet. We're going to go through the same transactions that we did for FIFO and LIFO. And again, those videos will be linked in the description so you can get the whole picture. And we're going to see what this average cost thing involves. So same set of transactions that we've done for FIFO and LIFO. And again, the spreadsheet will be in the description for the video so that you can download it. And you can actually use this to do your homework if you'd like to. So again, we've got our transaction type, we've got the number of units, we've got our cost, and we've got the inventory amount if we know it. And what we'll do is we'll go through each one of those transactions and I will show you what's going on in the accounting system as we're working through these so that you have an understanding, and it will help you to do this funky inventory spreadsheet thing that we only ever do in Accounting 1, and then we forget about it forever. So we've got three columns. We've got our purchases, our cost of merchandise sold column, and our inventory column. We start out with our beginning inventory, which is 120 units at $26 for $3,120. And this is one of those things that your textbook will give you. So if we're keeping track of this in our T account, over here in our T account, here is our beginning inventory we've entered for $3,120. So what happens in our first transaction? We have a sale right off the bat, 90 units. Well, what are we going to use for cost for those 90 units? We're going to use the $26 because that's what we have in inventory. So we're going to subtract our 90 units from our 120 units, which leaves us with 30 units at an average cost of $26, leaving us with $780 in inventory. This has been the same for all three types of inventory methods. It's been the same amount because it's our beginning inventory. The cost was already assigned prior to us walking in the building. On the journal entry side, we have sold some items. We've got to record both our revenue and the cost associated with that revenue. Because of what? The matching principle. So here's our accounts receivable for $4,500. We're assuming a $50 sale price to our customer, and we've recorded our revenue sales, a credit of $4,500. Our cost of merchandise sold, we're grabbing right from here. This is our 90 units at $26 for $2,340. So we're debiting our cost of merchandise sold to recognize the expense that goes along with that revenue. And we are reducing our inventory by those units that we've sold. So in our T account, we've got our beginning balance, we've got our reduction in inventory, our credit of $2,340, which gives us a balance in inventory of $780. Now, what's that $780 made up of? It is our 30 remaining units at $26 for $780. Now, the only time, key point right here, the only time you're going to update your average cost is when you purchase something, okay? The only time you're updating your average cost is when you purchase more units, which we're about to do. So we are buying 140 units. These are coming in at $28 for a total cost of $3,920. On the journal entry side, we are recording this as a debit to inventory. We're increasing our inventory, and we're increasing our accounts payable with a credit of $3,920. We have a liability now that we owe, so we've increased our liability account. In our T account, now we've got our $3,120 of beginning inventory. we have our previous transaction where we reduced inventory by $2,340 when we sold it to our customer, and now we are increasing our inventory by $3,920, giving us an ending inventory amount of $4,700. So what does that do for us on the average cost side? And this is where using those journal entries and T accounts can really help you with this average cost method. So we know that we have $4,700 of cost in our inventory right now. And we know that we now have 170 total units. We've got 30 plus 140. So we're going to take that balance in our inventory, which is the 780 plus the 3920, or pulling it directly from our T account of 4,700. We're going to take our 4,700 units, divide it by the total number of units that we have on hand, and that's going to give us an average cost of $27.65. With average cost, we want to make sure that we are using a couple of decimal points here, because the rounding otherwise will throw things off. It'll get very funky very fast, and we don't want that. So now our average cost moving forward will be $27.65. So then we're going to sell 110 units to our customers. We're going to use that new average cost of $27.65, and that's going to give us a total cost for this transaction of $30.41.50. I rounded it up to make it a little easier on us. So if we jump over to our journal entry side of things, we are recording the sale to our customer. We're selling 110 units, $50. So our customer is being charged a total of $5,500, and there is our sales revenue of $5,500. The cost that we are associating with this is our $30.42, which is our average cost of those units. So we're increasing our expense to now match up with our sale, and we are decreasing our inventory by that amount. Here's our T account. Our other transactions are there, and now we are also reducing our inventory by $3,042, which leaves us with $1,658, which I think rounds up to $1,659. Don't get hung up on that rounding detail, because again, this is only for accounting class, and this is not the way we do things in real life. So we end up with 60 units at $27.65 for $1,659. And then what happens? Well, we're going to sell 40 units. We are going to sell 40 units at $27.65. You'll notice we did not update our average cost because we only do that when we purchase something. So our average cost is still $27.65. We're selling 40, gives us $11.06. We come over here to our journal entries. We've got our accounts receivable. We're selling 40 at $50 to our customer, and we have our sales revenue of $2,000. And then we're going to have the second part of our journal transaction, which is the purchase side. You've got a sales side and a purchase side. So we've got our cost of merchandise sold, which we're pulling from here, $11.06, and we've got our inventory reduction of $11.06. We put that into our T account. We're reducing our inventory by $11.06, leaves us with a new inventory balance of $553, which is 20 units at an average cost of $27.65 for $553. Then we're going to purchase some new units. So we're purchasing 160 units at $30 for $4,800. So we know right away that we're going to have a transaction where we are increasing our inventory and we are increasing our accounts payable by $4,800. And there's your journal entry right there. We are booking our inventory and we are booking our accounts payable. When we add that to our inventory, now we've got a $4,800 increase in inventory, which leaves us with $5,353 in inventory. Now we said after we purchase things, we update our average cost, and that's what we're going to do here in our inventory window. So our inventory now is valued at $5,353. We can pull that right here from our T account, or we can take our ending inventory here and our addition to our inventory here to get to that 53.53. And we've got 20 units left in stock plus the 160 that we just purchased gives us 180 units. We take our 53.53, divide it by our number of units that we have, gives us a new average cost of $29.74 per unit. So the next time we sell something, that's the inventory number that we're going to be using. Now, if the textbook asks you for what was your cost of merchandise sold for the month, what we're doing is taking these different amounts that we assigned as a cost to inventory, and there is our cost of merchandise sold for the month. If it asks for a gross profit for the month, we're going to take our sales. We had 4,500 here, 5,500 here, 2,000 there. Gives us a total of $12,000 in sales. Our cost of merchandise sold, $64.88, pulling that right from here, which leaves us with gross profit of $55.12. It might also ask you for what is the value, the ending value of your inventory, or what's the beginning value of your inventory for the next month. It's right here. It's our 53.53. Now, I mentioned in all three of our videos here that this is not the way that we do inventory in real life. So what happens in inventory in real life is we're using computers to keep track of our inventory. So we're tracking things as they come in through the warehouse, and we're tracking things as they go out through the cash register. And that is automatically updating our inventory all the time. It's perpetually updating our inventory. So we know what we paid for those things because we've entered that in the computer as we go along. Now, if you're a small business and you're using accounting software, then what happens is each inventory item that you have in your store, you're entering that as a specific item within your accounting software. So it's being entered as what the sale price is and what the purchase price is. And then that can be updated for any of those items if you need to increase your sales price or if your purchase price increases. So we have a much better handle on things. But when we think about the way that we did things for accounting class for LIFO, FIFO, and AVCO, this is one item that we've been tracking. One item. Every single item on the store shelves would need to be tracked this way. So you can see that this would be a ridiculous way to keep track of inventory. So the good news is you can understand it for your accounting class and then understand that this is not the way you're going to have to do this in the real world. So don't lose heart and say, I will never have a merchandising business because this is a pain in my neck. So I've linked the playlist for this whole series about merchandising business and inventory in the description so that you can get all the various pieces and get it straight in your mind, and you can score that A in your accounting class because I want you to have that. Go get it. So until next time, stay balanced, my friends.